Hey guys, welcome to another video. This one is on PayPal. Now, I am happy to say someone watched one of my other videos and applied the philosophy of valuation. I'm going to assume it's a buddy, Luxa Rich. Thank you for the question. He's saying, let's do an urgent PayPal video. So that's what I'm going to do. Follow him on TradingView. And here I have Peter Lynch. I'm not going to debate or argue the technical analysis because nobody knows. It can go either way, especially if the times get harder. The only thing I'm here to push is the math. If we were looking at the business, what is the math? And the math, just so you know, it's not made up. I'm not saying anyone doesn't believe it or anything, but it is hard to believe. This is Peter Lynch. Peter Lynch is very famous for the Magellan Fund. And he used a philosophy of one, invest in what you know, companies that you already know and trust and use. They're probably a good start. And then if you look at peg ratio is just a formula. If a company is growing at, let's say, 20%, we don't want to pay a PE more than that 20 because the compounding doesn't work to it doesn't work in our favor if we're paying twice the growth rate. We don't want to pay more than twice the growth rate. This is another way of saying that high PE stocks are factoring in the growth rate. So it's a philosophy of saying, I don't necessarily want to buy just the value stocks because I'll get better performance from growth stocks. But how do we measure that? And he's not the only one that uses this formula, believe it or not. Uh, Warren Buffett's mentor, intelligent investor Benjamin Graham. I know it doesn't make sense. He's a boring value guy, but they also, too, have a formula. Now, he wasn't very strict about it. The Benjamin Graham formula, if you look, they take earnings and they apply a base value and then twice the growth rate. So, why are these old, wise men using the same formula? And that's what I've had to learn over a long period. I started investing, in 2004. I bought some stock. I became a stockbroker. I saw what they were doing, and I had to watch a whole cycle. Okay, so I'm applying this math when I'm using these formulas, and my model is based on looking at companies and how they've performed in the past, in the bad and the good times, and then applying, the math. If a business grows at a certain percentage, it will be so big in the future. There are good prices and bad prices. And I use four different valuations. Very often, stocks trade above my valuations, and sometimes they trade below the lowest valuation. And that's what a cigar butt is. And a bubble stock is when it's above even my two peg valuation. Okay, but nonetheless, let's jump into PayPal. So PayPal, if we're looking at the technicals, it's in some kind of a wedge. It's going to go either way. Nobody knows. I have a bear skew. However, they've already taken it down quite a bit from $300 to 72. Let me take the log off. Let me just do one of these. This looks just like ARK, PayPal, all of these, high leverage stocks. They went up, they're decimated. What's the percentage? And that's not even the highest high. It's down 80%. So it's looking pretty discounted. Now, let's jump over. I got a lot of articles, Seeking Alpha, a bunch of buy articles. So that's a good sign. They have positive earnings. Hey, they're making money. That's a good sign. PE non-GAAP is 14. Let's see, 30 billion in sales. What's the market cap? 80 billion. Okay. And then let's just make sure they have 11 billion in debt. 10 billion in cash. Okay, so they're self-funding, you know, and they're free cash flow positive. So it's checking all the boxes. I just had one thought. I wonder if investors are thinking that they have any banking risk. That's the other thing. So let's jump over to a new worksheet that I made just for this video. It's not even cleaned up. This is ADB. So if I punch in the earnings that I got from the worksheet, I apply a growth rate. I'm going to use 15% because when I looked at the earnings, it didn't look like earnings were growing much more than that. Now you can apply a higher growth rate if you like. The sales are growing closer to 10. Earnings are growing between 15 and 20. I'm going to skew it to 15%. And a Peter Lynch PEG ratio says it's fairly priced, 73 and 84 next year. So that's a good sign. And since the PE, we already know it's around 15, the 15 PE is also saying it's a fairly priced. So that that means that it will you will probably earn the 15% if it all goes as planned. When you pay one times the growth rate and it grows that growth rate, you're going to make that that uh, that 15%. And if you go out 10 years, according to my CAGR calculation, it's an annual 15 to 23% over a decade. So if you're comfortable with that growth rate, then by all means do your own diligence and your homework. But uh, the size of the opportunity is 4.8. The present value is $348 according to my worksheet, using a 10% discount. So this would be a green light. Now, the size of the opportunity right now is big. It could get bigger if the earnings decline, if the economy slows down. We don't know for sure what's going to happen. I think it will slow down. But also keep in mind, in a recession, things get wonkier. Um, Not only do earnings fall 50%, but the multiple also shrinks. In 2004, Apple had a huge discount. The size of the opportunity was 15. It was trading, what, 60 cents? And that was expensive. In 2008, the size of the opportunity was 13, and the CAGR offered was around 40%, and that was a 20% grower. Uh, so, although PayPal mathematically seems like a good opportunity, you're gonna have to wonder: do I know all the risks? Like, is there any banking risk? Is there any surprise I'm not aware of? And then the other thing you're going to want to wonder is this the only stock that's discounted? Is this the lowest? Is this the best opportunity? And then the other question, once you do all that, is what's the size? Like, you don't want to put all your money in one trade. Let's say you love it. For whatever reason, you think not only will you make X amount of money, it'll be even better. Like, you don't want to put all your money into one idea. You want to put you want to have your core in, like, ETFs or something stable, something diversified. And this would be considered like a satellite, between 2 and 10% maybe if you were really aggressive. If you're using just straight stock, maybe. But you never want to put all your money into one idea. And also, you don't want to do it all at once. So even if you think this is a great buying opportunity, you have to leave some wiggle room, because sometimes you get lucky. Like, what if this thing drops from 72 to 40? If you like it now and you're happy to make 25, see, this is why I love the worksheet again. Let's say it does happen to go to 42. You're happy to make 25%, 15%, but for whatever reason, for a few days only, a flash crash, whatever, let's say it goes to $50. It goes to $50. Let me see if it adjusted. I think it did. And then, yeah, see that adjusted. So the return goes from, let me go undo, from 23% to 30%. So it makes it a better deal. It means you're going to make more money. How much more money? That 4.8 becomes a 7. It doesn't quite double, but imagine you buy a little, it goes down, you buy a little bit more, and then you find out, hey, that was a recession. So you're gonna want to you're gonna want to play with some scenarios, but it does look like this is meeting the rules of valuation. You definitely didn't pay. What was the high price? Definitely not paying $300. You're definitely saving that. So imagine you paid $300 and in 10 years it's worth $300. Well, that's pretty annoying, isn't it? Imagine paying $300 and in 10 years it's still the same price and you lose 10 years of opportunity. Anyways, I did my job. This is the worksheet. It looks like it's meeting the valuation rules. So do with that what you will. I can't tell you to buy or sell. I don't know your situation, but it is meeting the fair value rules. It is probably at a fair value. If it were me looking at this, I think there could be a discount in the cards. So I would pray for a discount and get it even cheaper. I hope that helps. And if you watched all the way, go ahead and follow this person and tell them thank you for inspiring the video. Cheers.